remember I invested some of my money based fully on my emotions. And what I learned from that is you should never go and invest in something based on your emotions, because emotions can make you feel good about something in the short term, but in the long term you realize the truth. And you always know that if you have a plan and you work consistently over long term, you will always get better results. And a great example here is that if you buy stocks or in general invest in something more risky based on your emotions, it's much easier to, buy higher and sell lower, and basically it leads to losing your money. And that's why in this video I talk about 4 most common investing mistakes. And make sure to watch this to the very end, because these tips can make you much more smarter as an investor, and knowing these tips is going to be really helpful for you. So I would highly encourage you to watch this video to the very end, because the value you get from here is something you'll need when it comes to investing. Alright, mistake number 1. Not diversifying. So you've probably heard people say don't put your eggs in the same basket. The idea is that when you invest in something, stocks or bonds, funds, whatever it is, you gotta diversify your investments. It's not ideal to go all in on something, and if it doesn't perform well, basically you're gonna lose your money. Ideally, it would be good to have at least 10 different stocks, a couple of different funds, and so on. So you get the point. If you have all your money in one stock or one asset, it increases your risk significantly of losing that money. In order to get great diversification, I highly recommend to invest in ETFs or index funds. Have multiple stocks from different sectors. That's going to help you to diversify your portfolio. And why you should do this is that the well-diversified portfolio performs better than a single stock in the long term. And by the way, if you're liking this video this far and find these tips helpful, make sure you hit the thumbs up and subscribe to the channel so you don't miss the newest uploads every Thursday and Sunday. Now let's continue. Mistake number 2, timing the market. So if you're really interested in investing and you constantly watch how stocks behave, it can be kind of natural to try to time the market to buy it at the right point. Well, the truth is, the best time to start investing is now. Timing the market is basically impossible because it's very hard to predict when the prices stop going down or when the prices stop going up. But the solution for this, focus on long-term investing with steady disciplined approach. For example, when it comes to investing in different funds, you can automate the process and invest in them every month. So that means you're investing during the good times and bad times. And eventually, consistent investments over time outperform those who are trying to time the market. Timing the market can be effective in the short term, but if your goal is to grow your wealth over long-term investing, you should not be timing the market. Mistake number 3, emotional investing. So there's 2 things I want to cover: fear of missing out and panic selling. Don't combine investing and emotions, because you're much more likely to buy things you were not even planning to buy. And another trap you can run into is fear of missing out, so you end up buying things you actually should not buy. If you buy things because of fear of missing out, you might end up panic selling them, and that might lead to a bigger loss. Solution for this is have a concrete plan and stick to it. Whatever happens in the market, whatever people tell you to do, stick to your plan, make the investments you have to make, have your own investment goals, and know why you are investing. Avoid emotional decisions and focus on long-term growth. Before I tell you mistake number 4, comment down below what has been your biggest investment mistake. Mistake number 4, ignoring fees and costs. So look, when you invest in stocks or funds, so all of them have some kind of investment fees or management fees or trading fees. You gotta pay attention to them, because especially over long term, if you basically don't pay any attention to these fees, they're gonna eat your returns over time. When it comes to investing in funds, I recommend investing in index funds. They're not only beginner friendly and easy investments to get started with, they have also low fees, which you can take advantage of, because many mutual funds may have management fees that are over 2%. And you don't want to have such high fees, because over long term, you'll see they eat your returns. Same applies for stocks. Make your investments based on logical decisions and know what you're buying. If you're buying and selling all the time, trading fees can add up a lot, and you're not even realizing that you're spending a lot of money on fees. The solution is low-cost index funds or exchange-traded funds. And in general, if you compare 2 long-term portfolios, one with high fees and another one with low fees, the one with higher fees will have much more costs, and especially over long term, it adds up. And basically those fees and costs eat your returns. And that's something you have to be really aware of when it comes to investing. The best thing is that whenever you make an investment mistake, or you realize that something wasn't really necessary to do, the best part is that you learn from your own mistake, and that's what keeps you pushing harder and reach your investment goals. That being said, hopefully this was helpful and motivating. If you are interested in more of this type of content, make sure to watch this video next. It is my most recent upload. If you're new to the channel, click here to subscribe. Thank you guys so much for watching, and I'll see you in the next one.